I think the U.S. valuations are somewhat stretched at this point. I still think the U.S. is still a reasonable place to invest. I don't think it's massively overvalued. I call it stretched. But I think you are going to see significant impact on other economies with what's playing out with tariffs. I just saw in the hits that you had prior to me joining you about all the drama that's happening in Japan right now, what that 25% might mean to them. The European Union, I think, will probably negotiate down to 10, 15%. That's fine. But I do think you're going to see impact on other economies because of tariffs. Now, that may be concerning in terms of global recessionary fears, but I do think it makes sense to be diversified around the world. Remember, U.S. companies, while it sounds like they're U.S. companies, that's pretty much where they're based. It's not where all the revenue comes from. So you have a significant percent of global revenue coming from, or revenue coming from all around the world. So I think it's important to continue to have that mix of global. I am of the belief, and of course we're a U.S. manager, so it's not surprising we believe this, that U.S. equities still provide an opportunity. There's pretty high dividend rates right now. But I would not avoid the rest of the world. There are some trouble spots. Latin America has problems. Obviously, China is challenged, and Japan is facing tariffs. But I think diversification globally certainly makes sense.
Yeah, so I hear you talking about a U.S. evaluation looking a little bit stretched, and then you bring in the Japan angle. And then I'm thinking about what happened last summer. At the end of August, was it, that yen carry unwind concern or related to market route, and really nobody has one clear answer what led to that kind of market correction. How come we don't really talk about that anymore? Because if you look at the 30-year, the long end of the JGB curves, I mean, it's higher than where they were last summer, and yet nobody is talking about carry unwind market route. What do you think that is?
I don't know why they're not talking about it beyond the fact that there's probably other things that are more pressing to talk about, is what it comes down to. I mean, you and I know that we're always looking for headlines here, right? So if there were no tariffs, we probably would be talking about the unwind. And I think that continues to be a concern and is certainly going to create market volatility. But I think there's such fundamental things happening right now in terms of trade policy on a global basis. I think everything is kind of lurching towards some sort of conclusion this year. Then we'll have much more time to talk about the carry issue that you talked about, as well as the health of each economy. So I don't think it's the primary concern, I guess, the short answer. And I think it's something certainly to watch, but it's not the primary concern.
Yeah, I mean, it's not a primary concern, and obviously the world has bigger problems to think about right now, obviously, so I think that's probably why. And I'm just trying to figure out why you're saying don't bank on interest rate cuts, because if the market is thinking, okay, the Fed is going to cut, the BOJ is going to normalize, or at least the direction of travel is hiking for BOJ, then perhaps there is less reason to worry about unwind here. But if you're thinking, okay, Fed is not cutting, then we have a problem, no?
Yeah, we probably do, because the market is actually expecting the Fed's going to cut. I haven't seen the latest numbers off of Wall Street economist surveys, but it used to be that 25 or 50 basis point cut between now and the end of the year was all but a certainty. The probability of that is going down. Now, is that a problem? It absolutely will be a problem if we have the input of tariffs, which is higher price. We start moving into something that starts seeming particularly familiar, stagflation, right? Now, the big wild card is we have all of these all these factors that are inflection points simultaneously: tax policy, interest rates, trade policy. The U.S. unemployment rate has held up well. Unemployment is not going up in the United States. So I think there is a risk that if all of a sudden we wake up and we realize, wait a minute, the Fed is not cutting, I think the equity markets certainly will be very, very vulnerable in that situation. I think the people are starting to become afraid that might be the case. And if interest rates don't go down, then the question is, are you keeping them too high? And is that going to really hamper the economy? And I can only imagine what the president will have to say about that.